Hello, and thank you for joining. One of the big questions right now is whether the weakness we're seeing in consumer and business surveys is actually translating into real economic slowdowns. One of the best tools we have to monitor that in real time is the Weekly Economic Index, or WEI. This index aggregates a wide range of high frequency data, things like jobless claims, fuel sales, steel production, and tax withholdings, to give us a clearer picture of actual economic activity. And what it's telling us is pretty straightforward. Despite the pessimism in the surveys, there hasn't been a meaningful drop off in the data. In fact, the WEI has stayed well above 2% for most of the past 6 months, suggesting the economy is still growing at a decent pace. So while sentiment may be softening, the hard data says we're still holding steady. That divergence is important to watch as we try to separate noise from signal in today's economy. When you hear that the equal weight S&P 500's forward PE is essentially right at its average over the past decade, here's what that really means. One, valuations are not stretched across the board. When you strip out the influence of mega cap stocks and weight all 500 companies equally, the market looks reasonably priced. It's trading at a valuation that's in line with historical norms, suggesting that the average stock is not overpriced. Two, the broader market may be fairly valued. The equal weight index offers a clearer view of how the median S&P 500 stock is valued. This implies the average company is not in a bubble. There may be real opportunities outside of the dominant tech giants driving most of the performance in the cap-weighted index. Three, concentration risk is real. The cap-weighted S&P 500 is heavily influenced by a handful of expensive mega-cap stocks. That means investors relying solely on the traditional index may be more exposed than they realized. The rest of the market appears more reasonably priced, potentially overlooked by those tracking only headline metrics. Historical context provides clarity. Valuations that sit at long-term averages indicate balanced sentiment, not exuberation or fear. This context helps investors form a more measured view of potential risks and rewards going forward. If you're trying to gauge where the economy might be heading, one of the most reliable early indicators is consumer confidence. This chart from the Conference Board tracks consumer sentiment back to 1980. And there's a clear historical pattern. When the index drops more than 20 points in a 3-month span, a recession often follows within 6 months. We're not quite at that danger zone, but we're getting close. Over the past 3 months, consumer confidence has fallen by about 16.6 points. That's just a few steps shy of the recession warning threshold, and the trend is not encouraging. This month's data marked the lowest level since January of 2021. Why does this matter so much? Because consumers power 2/3 of our economy. When they feel uncertain or lose confidence in the future, they pull back on spending, on hiring, on investing. And when that behavior changes across tens of millions of households, the ripple effects are substantial. Now, this is considered soft data. It reflects how people feel about the economy, not necessarily what they're doing yet, but it's often a leading indicator. The change in behavior tends to follow the shift in sentiment. And when you pair this with rising policy uncertainty, political transition, and slowing job growth, it starts to paint a more fragile picture of what's ahead. So while we're not sounding alarms just yet, this is one of several indicators flashing yellow. If confidence continues to fall, it could be the tipping point that shifts a soft landing into something much more difficult. Thanks for listening, and if you have any questions, please let me know.